Imagine waking up one morning to discover your life savings, let's say $10,000 vanished overnight, not because someone stole it, but because you trusted the wrong sure thing. Heart pounding, you realize you were sold a dream, not a strategy. That fear, that gut punch, is exactly what Benjamin Graham's The Intelligent Investor was written to protect you from. And it's what Warren Buffett studied so deeply that years later he said almost every big decision he ever made drew from that book. Today, I want to share 5 rules Warren Buffett learned from The Intelligent Investor, not abstract finance speak, but real, breathing lessons you can live by. These are rules born in boardrooms and kitchen tables, in hopes and regrets, in moments just like yours. First, don't confuse price with value. One of the earliest lessons Buffett internalized from Benjamin Graham is that price is what you pay, but value is what you get. Think of a time you hurried into buying something because it looked flashy, a car, a phone. A story about this is the next big thing, only to wake up months later realizing parts have broken, the warranty is useless, you paid way more than what it's worth. Warren saw that happening all the time. Back in the 1950s, when many folks were betting everything on hot stocks, Buffett waited. He watched companies that looked boring, utilities, soap makers, sell at low prices because the world was infatuated with fast-growing tech promises. And guess what? Over decades, many of those boring companies trounced the flashy ones. On your level, maybe you buy into trends and hype, a gadget, a diet plan, a coaching program. Price seems low if you pay with credit cards or faith. But value, what it actually gives you long term, might be nearly nothing. So the rule is simple, always think long run. Is the purchase going to deliver real, durable value? If not, the cheap price might cost you way more. Second rule, margin of safety. Buffett learned that Graham's margin of safety isn't just a financial buffer, it's psychological and emotional. In The Intelligent Investor, Graham says only buy a stock when its market price is well below your estimate of its intrinsic value, so even if things go wrong, you're cushioned. Imagine you think a company is worth $20 per share, but the market price is only $12, you've built in an $8 cushion. Real life, remember when you plan for emergencies, job loss, medical bills, car breakdowns, you create savings, insurance, backup plans. That's margin of safety in your life. Warren Buffett sat through recessions, watched companies fail, saw economies crash, but he held businesses that had margin of safety, low debt, predictable profits, solid customer base. That meant when storms came, they sank a little but didn't wreck him. For you, it means don't bet everything you own on something so volatile, so trendy, so untested. Save a chunk, don't borrow wildly, build redundancy, that savings account that scares you to leave alone, the relationships that hold you up, the skills transferable across jobs, those are your margin. The third rule, be fearful when others are greedy, be greedy when others are fearful. It sounds almost like cliché advice for meme stocks, but Buffett didn't pick this up from memes. It's straight from The Intelligent Investor's deepest wisdom. When everyone is piling into something, everyone's saying this is the best time ever, that's exactly when you need to pause. Because often that best time ever is deeply overpriced. Warren's own experience, in the late 1990s, when dot-com fever was everywhere, he looked at companies with no earnings, no revenue even in some cases, and thought, everyone's greedy. He waited. When the collapse came, he already steered clear. Then, when fear was everywhere after the crash, when people said the market's done, economy's toast, he stepped in. He bought companies that were solid, discounted, undervalued. You and I, we see fear in our lives too, fear of missing out, fear of letting opportunities go. Everyone else is investing in that stock, that scheme, that quick win. But maybe the real win is stepping back, thinking, researching, letting fear settle, waiting for price and value to align. And when everyone is panicking, that might be your moment. Not bravado, but courage grounded in understanding. Fourth rule, invest for the long term, ignore short-term noise. One vivid story Buffett often tells, early in his partnership days, he bought shares in companies that looked inexpensive relative to their earnings. He didn't day trade. When prices dipped, news worsened, pundits predicted doom, he held on. Because he believed in the intrinsic value. Over years, sometimes decades, that belief paid off. Some companies got through recessions, war, inflation. Others went out of business. But by focusing on durable businesses, he rode through the storms. In your life, think of relationships, careers, building skills, these are long-term investments. One day you date someone because everything feels electric, another someone because you believe in who they are, what they stand for, and you build together. One job looks shiny, another feels solid, grows you. Maybe you invest in learning a craft that doesn't pay overnight. In the valley of short-term pain, short-term losses, you may see nothing. But 2, 5, 10 years later, you look back and everything shifted, doors opened. That's what Buffett means by ignoring noise, the daily news, the quarterly earnings, the hot rumors, they mostly distract. Value is built quietly, steadily, when you're consistent, grounded, committed. And fifth rule, know thyself, stay within your circle of competence. Graham and Buffett both emphasize that you should only invest in companies whose business you understand. If you don't understand how profits are made, risks involved, what can go wrong, don't buy it. Buffett once said, if he doesn't understand how a business works, its competitive advantages, its revenue model, its costs, he won't touch it, even if someone promises huge returns. Real life analogy, maybe you feel pressure to start a side hustle because you saw someone else doing it, or because everyone's on TikTok doing the next thing. But if you hate sales, if you don't enjoy building product, if you don't understand the market, you'll burn out. I knew someone who jumped into crypto projects they barely understood. They lost half their money when a new regulation kicked in. Another friend started reselling phones. He understood supply chains, repair, warranties. He invested slowly, built relationships. Now he runs a decent small business. Knowing what you're good at, knowing what you can reasonably learn, where your blind spots are, that gives you an edge. And staying within that circle of your competence, or slowly expanding it, helps you avoid tragic mistakes. So, those are 5 rules Warren Buffett learned from The Intelligent Investor. Know the difference between price and value. Build margin of safety. Be fearful when others are greedy and greedy when others are fearful. Think long term and tune out the noise, and stay inside your circle of competence. But let me drive this home with a story. Several years ago, I met someone, call her Aisha, who invested her savings, $5,000, into a startup promising exponential returns. It looked flashy, big website, buzzwords, Instagram endorsements. She believed in everyone else's doing it, so FOMO kicked in. Within a year, the startup ran into legal issues. The product never shipped. The website went dark. She lost almost everything. Then she started over, studying books like The Intelligent Investor, learning about value, margin, circles of competence. Her next investment was thoughtful. She picked a local business she understood well. She loved baking, understood costs, demand, local suppliers. She invested $2,000, helped them grow, took a share of profits. 5 years later, that business is thriving. She's getting returns, community respect, comfort. Her mindset shifted. Warren Buffett didn't become Oracle of Omaha by chasing the next hot tip, or by listening to what everyone else shouted. He became what he is by understanding value deeply, by having margin when life turns ugly, by being bold when others are panicking, by being patient while others clamored for quick wins, and by sticking to what he knows. You don't need $1 million to apply these rules. In fact, sometimes starting small, your first job, saving your first 100, choosing your friendships, relationships, what you believe in, is where these rules matter most. Because when your foundation is built on predictable value, safety, patience, self-understanding, then growth becomes organic, being wrong doesn't shatter you, and success doesn't become an accident. Because here's the thing, life will test you, with market crashes, with broken promises, with trends telling you this is it. But if you've leaned into these rules, you'll wake up one morning not to fear, but to possibility. Your $10,000 haven't vanished, they've quietly multiplied, or perhaps they've turned into experiences, relationships, character. And that, more than anything, is the real wealth The Intelligent Investor and Warren Buffett point to. So remember, price versus value. Margin of safety. Fear and greed. Long-term over instant. Know yourself. Live those. And you won't just survive the next financial crisis, you'll thrive through it.